2014 is going to be a big year, so let's start digging for value. I'm Allison Southwick, and I'm joined by Tanner Muckerman and Joel South, so we're just going to get down to it. Our first story is over at Fuel Fix. According to Barclays, oil and gas companies will spend more money than ever on oil and gas exploration production next year, $723 billion. That's about a 6.1% jump. So, Joel, what is driving the higher spending?
Well, first off, the price of oil is high. It's been high, and there's expectations for it to remain high. So you're seeing a lot of big oil companies going into those long contract, big projects that are very expensive offshore. If you look at four of the top players, ExxonMobil, Chevron, Shell, and BP, they basically make up about $135 billion in capital expenditures. As Taylor will talk about later on in the show, if you look at Chevron and what they're doing in Australia, they had a project that was expected to be $37 billion. Now it's up to $54 billion. So it's very expensive. And, if you look at the price of crude, it's based on the United States dollar. So people are expecting that to stay high, especially once the Fed stops tapering. The price of oil with inflation could increase. So high oil prices is really driving this. Big projects, more expensive shale plays, and offshore drilling is really what's causing the big bump in capital expenditures.
So what's an investor to do with this information?
So it's tough. It's very risky if you're getting into a lot of the E&P companies. So what I would look is for a lot of the service companies. Offshore drilling, I think, is really the space to be in. If you look at the amount of resources overall, crude resources, about 7% is expected to be offshore. This is a market that's supposed to double over the next 5 years. So, when you look at that, I like Seadrill. They're not a company that has a lot of new rigs, high day rates. They have an extremely large dividend yield. So that's one company that I would focus on. They're in a prime market with a lot of deep sea drilling ships. I also like, so there's another company that's really growing. There are also offshore deep sea drilling ships, a lot of new ships. Those are two companies that I think are primed to really take the most advantage of the increased capital expenditures.
All right, let's move on over to the Financial Times. They are reporting that the world's largest LNG gas development, the Gorgon over in Australia, is even more behind schedule and even more over budget, according to Chevron, who's leading up that project. So how bad are things over there?
Well, it seems like it's a New Year's resolution for Chevron to increase the expected budget on this. It started off as $37 billion a few years ago. Last year bumped up to $52 billion. Now it's supposedly going to be $54 billion. So I don't really trust anything they're going to say until it's actually finalized. That being said, this is the largest project, as you mentioned, in Australia right now. It's a LNG facility that's going to be distributing LNG around the world. It's going to help Australia be, if not the largest, one of the largest LNG distributors, competing with America and Qatar as well. So those are going to be the three main players, I think, as you look at LNG being expanded around the globe. And this project, once it's finally online, not only did they say the overrun is happening, but it's also going to come online a few months later. So middle of 2015 is now the expected startup date.
So looking to other parts of Australia, are you seeing the same story? What else is going on in the country?
Well, yeah, Australia is just seeing a huge spending boom right now as far as LNG, not just on land, but offshore as well. Shell just dropped its floating LNG facility called the Prelude into the water, the largest floating structure ever to be built. And that's going to be $12 billion, like I said, and it's expanding the horizons of what's possible because not all LNG and natural gas finds are onshore. So now this ship is going to be able to be towed around the world. After they develop around Australia, it'll have access around the globe if this project does prove successful. So compared to what Chevron's doing, it's not quite as big of a bet, but I think it could be more inventive and even more useful because it's not stationary.
All right, moving on. Exxon is calling on the U.S. government to lift restrictions on domestic crude exports. Sorry. Joel, what are the details as far as what they're asking for, what they want?
Yeah, they're definitely looking pretty far into the future. They're seeing so much production come out of the United States, and if you look at the amount of motor oil, gasoline that's being used, that's been on a decline for about 4 years now. So, looking forward, they want to be able to have that, be able to rely on exporting crude if there's a huge glut that really drives the price of WTI prices down. And there's a lot of threats that are going this way. If you look at a lot of dynamics that are happening right now with electric vehicles, a lot of large trucking companies are switching over to natural gas. So if you can't export actual crude, you're really restricted by the amount of refining because you can refine a product and export that. but you'd have to really grow your refining exportation. So, they're just looking forward. If there's a huge glut, they want to be able to know that if they're investing all the money in the United States, they'll be able to move that oil somewhere else.
So ConocoPhillips and also Royal Dutch Shell have called for a lift on these restrictions as well. So do you think it's going to happen?
I don't think it's ever going to happen. If you think about it, it's been in the policy forever in the United States. It's really in the psyche.
Since the oil embargo.
Yeah, exactly. Well, that and even before. It's people are always realizing that oil is part of the national security. So it's really not going to happen. You're seeing actual exportations in natural gas, but with motor oil, there's not that substitute. Where natural gas, you can go and use coal for energy, to create energy. You can also, big nuclear fleet that we have. So there's a lot of other substitutes. So people aren't as focused on natural gas as they are with motor oil. So I don't see that happening. And what could be good if for investors, if you see a huge glut and you see motor oil continue to decline, that could be very good for a lot of refiners like Phillips 66 down on the Gulf Coast, where they have the opportunity to increase their exportation and tap a lot of the global markets. So those would be a great place as that WTI Brent spread happens, like Exxon's worried about right now.
All right, for our last story today, we're going to head over to Rig Zone. Marathon has announced that they are going to increase their efforts in shale, specifically in rig activity in the Eagle Ford and the Bakken.
Right.
Meanwhile, they're getting out of the UK and the Norwegian North Sea. Is this the right move?
It seems to be a recurring trend now. Marathon's just the next company in line. A lot of smaller companies in the United States pioneered the shale boom a few years back, late 80s, 90s, and it really took off in the early 2000s. And so big oil is starting to play catch up. They're realizing that international exposure is a little bit maybe more risky, a little bit more expensive with currency fluctuations, also regime risk in the Middle East. So you're seeing Marathon. I don't think the North Sea is the riskiest place in the world, but some people worry about production drying up there a little bit. So like you mentioned, Eagle Ford and Bakken will be a big area of concentration, supposedly increasing rig activity by 20% there, but 100% in the Oklahoma-Woodford region. So the Texas-Oklahoma basins, and then also in North Dakota is where this company is going to start concentrating. 60% of their capital expenditure budget next year will be North American focused. So it's a bit of a shift for Marathon.
So you said it's part of a trend, a larger trend of getting out of foreign assets. Yep. Who else? Who started this trend, or who was earlier on than Marathon?
A little earlier on, you've seen companies, I thought, more reasonably so, getting out of higher risk areas. You saw Apache sell off in Egypt. A lot of people thought that their Egyptian assets were holding the company's stock back because there's so much worry in that area. So now they sold off, not entirely, but they did sell off a little bit of those assets. And it's a huge change for them because they had spent $16 billion in just 3 short years to build out their international portfolio, expecting that to be the growth and U.S. to be the cash cow. But now they're reversing course and using international cash to fund growth here in the United States. They're really concentrating on Texas and Oklahoma as well. And then you have Occidental Petroleum, a slightly larger peer. A third of their production comes from the Middle East, but they're starting to sell off that or offer that up for sale to concentrate on the Permian Basin, which supposedly might be the biggest basin in the world if it can be produced at a high level. So a lot of big names are switching course and finally providing the EOGs and the Kodiaks of the world some praise for their reason to stay here.
All right, that's going to do it for the headlines. Let's head over to the Twitters where we are answering your questions. If you have a question for us, we're just a tweet away at TMF Energy, or you can send us an email to energy@fool.com. So our first question comes from Woot, the Woot Monkey. And the Woot Monkey wants to know, I have been tempted to dump my shares in ConocoPhillips. Talk me off the ledge. Joel, are you going to do it?
Yeah, Woot Monkey, it seems a little fatalistic by talking him off the ledge, especially when the company has been up significantly this last year, and it has the highest yield of any independent E&P. But when you look forward, this is still a great value. I think you should hold on to this company. If you look at their growth, they have a great growth plan and margin expansion in place. About 50% of their capex this next year is really going to the lower 48. That's where they see a lot of oil growth there. They have great position in the Eagle Ford, the Bakken, and the Permian Basin. So, they're looking fantastic there. If you look at their whole portfolio, over 80% of their production is in the OECD. So like Taylor was earlier mentioning, mentioning, a lot of those risky assets, you don't really have to worry about that with this company. You know, also Shell was a company that's selling a lot of assets in Nigeria because they're spending a lot of money there. Just too much risk. So you don't have that as much risk with that company. And on evaluation right now, this is a company that has a lot of growth, unlike a lot of their peers. They're basically a large integrated, not an integrated, a large national oil company or oil company that is growing, unlike a lot of the Exxons and BPs, but they're growing a lot and they're expanding their margins. Basically, you're paying under two times book value for this company. You know, they have a tremendous portfolio. They're going in the right direction. Their capital expenditures is in the ballpark of $16 to $18 billion, unlike the 30, 40 billion that you're seeing in the bigger players. And they have a dividend that competes with all those. This is a company that I think is still a great value right now. So Woot Monkey, I would definitely hold on to it.
All right, then we're gonna
keep that name. That's awesome.
Right. Moving on to in another good Twitter names, we've got Vincent Romero at Funky V Romero. And he wants to know, does clean energy fuels turn a profit in 2014? Taylor, look into your crystal ball.
Ooh. Well, I don't think 2014 is a guarantee, but 2015, I will place my money on that for sure. If not, 2014, I think that that's the case. You look at the joint venture with Cummins Westport, producing a 12-liter, 400-horsepower engine, run on liquefied natural gas. They started that in August with like 200 trucks per month. Now they're up to 600 to 700 per month. And the CEO, Andrew Littlefair, strongly believes of Clean Energy Fuels, not of the joint venture. He strongly believes that that's going to continue to increase, reaching 10 to 12,000 of these trucks on the road in 2014. And that's when they're going to feel confident about providing some future guidance, because that's the main market they're looking for, is this heavy-duty, long-haul trucking market. And then you add on to that that GE and Caterpillar are competing to try and provide liquefied natural gas locomotives for the likes of BNSF and CSX. I think that you look at Clean Energy Fuels as a company that's way ahead of the game here. They have a lot of different industries, all collapsing on top of natural gas as a transportation fuel. So I think that they're in the prime position to capitalize. Whether or not the profit comes in 2014, I'm not sure. I would assume yes, but 2015, I would put all my money on that.
Oh, all right.
I want his iPad. Mine doesn't have a crystal ball.
I know, right? All right, well, before we go, I want to let you know about our philanthropy campaign this year. We're going to be raising money for Pencils of Promise to build some schools in Nicaragua. It's an awesome cause. If you want to join other Fools in supporting it, you can go to fool.com/give. For Taylor Muckerman and Joel South, I'm Allison Southwick. Thanks for watching.